Welcome to the MHP Exchange, where the riches are in the niches. We'll show you how to invest your way into mobile home parks with real strategies, tips, and behind-the-scenes know-how to grow your cash flow. Stick around. This is where smart investing begins.
Welcome back, everyone. The truth is about mobile home park investing, the money is the great filter. I mean, everyone wants to buy a mobile home park, but very few people understand what moves the capital behind it to get the deal done. But my guest today knows that better than anyone. Mordy Jurkowitz from Princeton Capital has been in the trenches of mobile home park financing for years. He's seen what lenders say publicly. He knows what they think when your deal actually hits their desk. And so if you've ever wondered why your deal hasn't gotten funded, or you want to know what it takes to get your next deal funded and closed, you're going to want to listen to this episode. Mordy, thank you for joining us today.
It's an honor to be here, Frank. Thanks so much for the opportunity.
And full disclosure, Mordy and I have known each other for years. We've had the ability to work on deals together. And working with him and his team has really been a cut above, because they really understand the space. And Mordy, you've been in the mobile home RV financing for 7 years now in that specialty. Got it.
Yes.
How did you get into this line? Like, what made you decide, you're in commercial financing, that you're going to specifically focus in the MH and RV space?
Yeah, that's an interesting question. So I actually have an uncle, my father's uncle, my great uncle. Ever since I was a kid, he owns a bunch of parks on the West Coast. I think 6 mobile home parks on the West Coast. He developed them himself in the 1970s. Came over from Europe with nothing. One of those cool stories and real rags to riches stories. And, he became a very wealthy man through the industry. So ever since I'm a kid, in our family, we've always been talking about mobile home parks. Uncle Morris, he lives in California. He did really well in the industry. And ever since I'm a teenager, I've always been fascinated by real estate. I always wanted to get into the real estate industry, sort of in some form. And I had an opportunity to, I was going to work, I wanted to go into finance, and I was, trying to choose a firm, and sort of Princeton Capital Group, even before I existed, sort of had a niche in the mobile home park industry. And they really brought me on to focus specifically on MH and RV, and, sort of learned from the ground up. And, really the rest is history. I love the industry. I appreciate it. It's intimate, everybody knows each other. And, it's really been a great experience for me so far. And working together with you guys, working together with operators, and really making a difference in the industry, makes a difference to me. And I really enjoy it. It's really going well so far.
And having that family background in the space, like, how do you think that gives you a little bit of a competitive edge, knowing the space from both sides of the table, I would imagine?
Yes. So I remember meeting my uncle, and him telling me really a lot of the challenges that he faced. It's very interesting. Imagine in the 1970s, 1980s, you know, the stigma is real, quote unquote. Even nowadays, obviously things have changed immensely, and the lending world is a lot easier. But just hearing from my uncle, he literally could not get a loan in the 1980s. Trailer park, no bank would touch it. Even Fannie and Freddie in those days, it was a whole different landscape. And just hearing the challenges from him and what he had to overcome. Investors, like, he tried to raise capital, and he had a really hard time. People didn't believe it, didn't believe in it. And he has all the war stories, and just hearing them, hearing those stories from him, and how he really persevered, and he stuck to it, and literally developed the parks lot by lot. That's the way he did it. He had a plot of land in California. Nowadays, it's impossible to really develop parks in a lot of areas of California. He owns parks near San Francisco. Very hard, the barriers to entry nowadays, it's almost impossible to do something like that. But just
Sure.
hearing from him how he had an extra couple $1,000, he would clear a lot, try to bring in a home. And just hearing from him, how he built his whole business ground up, and all the difficulties he faced and really persevered, I think really set the tone for me. And I think it does give me a competitive advantage. Just, understanding, you know, I'm in the lending world, right? But I want to be able to put myself in an operator's shoes, and try to understand the challenges they face, and try to understand, okay, I need capital for XYZ. I think specifically for a lender, there's the lending world, but really trying to understand, operating a park, and trying to, put yourself in the borrower's shoes really does help, really present the narrative to the lender, try to paint the proper picture to the lender, and it really translates into success. Because again, like I always tell clients, you got one shot to present your deal. You want to present the deal in the best possible way. You want to paint the full picture, to the lender, what the really the goal is with, with the capital request. And if you present it in the proper light, your chances of success just go up astronomically.
And you know what? I want to go on that point because how much does the story matter, right? How much does the operator's track record matter? The turnaround story, like how much does that matter from the lender perspective? Is it different bank by bank, or in putting together that narrative, does that make the difference? In terms of getting the deal funded or not?
Absolutely, that's a great point. So I always tell people, right? A guy will send me a deal, and it's a couple of days later, and they're like, they check in, they text me, they email me, okay, where are we holding? And I say, you know, it's very important to take the time, especially if you're, let's say, introducing a client to a new lender, to a new relationship. It's super important to take the time to make sure that, number one, I understand the deal from A to Z. So I'm going to ask a lot of questions, try to really be able to paint the proper picture. Because, like I said before, you got one shot at presenting a deal. You want to make sure you got your facts straight. You want to make sure you're painting the park and the sponsor and the goal and the sponsor's business plan to the lender in the best possible light. So just to give you a little picture of the process, right? So we'll get the financials, we'll get the basics of the park. But then I would say one of the most important things is I'll look into, let's say it's a new client. I'll try to really dig in to the client's background, to the client's successes, whether it's, stories of hey, this guy had a park, he turned it around, and just really to talk to your point, I would say now more than ever, really, sponsor experience is key. So a lender, I would say a lot of the parks trading today are really not the class A parks. I think there's a big disconnect between buyer and seller on those. There's a lot of value add deals trading. And how do you get a value add deal across the finish line? Right? You have to sell the sponsor's business plan. And the bank, in order to sell the sponsor's business plan, you got to paint the picture of the sponsor that, hey, this guy knows what he's doing. He's done this before. He's going to be able to execute with success. So I would say now more than ever in the challenging environment that we're in, sponsor experience is absolutely key. I've gotten parks done, hairy deals, 30, 40% occupied. You would think it's like absolutely unfinanceable. And then really just getting the lender to hang their hat on the sponsor's experience, I would say that makes all the difference.
It's funny you say that because first of all, when we first got into the space, there was very few lenders that even wanted to touch mobile home parks. And then the ones that did, they wanted a track record from you before they would even consider doing a deal. So you either had to own the park for a year and then they would consider financing you, or they wanted you to have somebody who had some experience to do that has been in the space. Do you still find that bias here and that? Like, so if you're a new operator and you're looking at a park and you've never done this before, is it are they still going to have that same type of roadblock in terms of getting the deal done?
It's, it depends on the lender, but I would answer that with a yes. And, so I get people all the time, I have a guy, let's say he's been in the multifamily space or he's buying retail, industrial, never bought a mobile home park. So I would say a guy like that who could show experience in real estate in general, you could find a lender that will give him a shot, even if he doesn't have experience in the MH space at all. When it comes to multifamily property, I would say it's a lot easier if you're a rookie, quote unquote, to get a lender to give you a shot. Whereas in the MH space specifically, if you don't have much experience in real estate, or even if you have experience in real estate, but you don't have the experience in MH specifically, I always tell those, I get approached by these, people that, they went to our course and they're getting into the MH space. How am I going to get my first deal done? So I always say you're going to have to partner with someone on the first one, two deals. Get a guy who, knows the space, has a good track record, get him to sign along with you on the first couple of deals. And then, once you have a couple of deals under your belt, you could show some experience, then, hey, we'll go off on our own. But I think the way around that is really to partner with someone with experience. That's what I've recommended, and I've seen many people have success, and then all of a sudden they're off on their own, running, buying, with 1,000 lots. But you're definitely correct. It is tough in the beginning to get that first one off the ground.
It's hearing it from you, and we've said this to people who have approached us who've asked us questions about the space, and we would say the same thing. Like your lenders are going to have a hard time if you haven't had experience in space getting it done. But hearing it from someone who's really interacting with the lenders directly, like yourself, I think that just adds some more weight to
And
it.
I'm
So
sure
that's very,
people approach you, Frank, being like, "Hey, I'm a rookie. Could you help me out here? Could you sign along with me?" I'm sure you've gotten approached by those type of folks before.
cor- correct. And everyone wants to do it themselves, but it's also, if you need the bank to be part of it and the bank is going to participate, they want to know that you have that track record. Now, from the lender's perspective, or for your perspective, like, what are the top three things to make that deal bankable that someone should be looking at, or that you look at, that say, okay, this is a bankable deal? Like, so obviously lender's track record being one. What are the other? Are there anything else that you're looking at as like, hey, we need this to make this a bankable deal?
Yeah. So specifically on a value add deal, I would say the number one thing, the thing that I dig in first after sponsor stuff, would be performa numbers. And pull it 2021, maybe even 2022. Banks barely looked at the financials. Things were a lot easier. They dug in a little bit. Now, obviously, things have changed. You have deals underwater. Lenders are, maybe don't have as much liquidity as they used to. They could afford to be picky, quote unquote. So they're going to look at the performa. They're going to say, okay, what is this sponsor's plan for bringing in new homes for infill? You know, he's going to be cutting expenses. Is that realistic? How is he going to cut expenses? He's cutting payroll. How is he cutting payroll? To really nail down the business plan, to nail down, how am I cutting expenses? Oh, he's raising lot rents to $600. Is that realistic for this market? Market comps. So that's something that I'll dig into. That's the first thing right off the bat, making sure that the sponsor's pro forma is backed up by real facts. It makes sense. It's realistic. And then presenting it to the lender. I would say that's number one. Number two is, we had difficulties, call it, in the COVID years with, infill, bringing in homes. That was a huge challenge to, sort of sell off on the value add deal. Like, oh, you're going to bring in homes. How are you sourcing those homes? No one could get homes. Now things obviously have eased up. It's easier to get homes, but it's interesting. I would say in the last year, you have a lot of lenders, and I'm sure we'll get into this soon with the park owned home versus tenant owned home conversation, underwriting, but we'll get to that. But lenders that don't even care about the park on homes, they don't take them as collateral, they don't underwrite the income and expenses. They've started to ask a lot of questions on the park on homes, and I'll explain why. You have your chattel lenders that I personally don't deal with, but obviously, you got your big ones, 21st Mortgage and Triad and Legacy, and the list goes on. But they've definitely been digging in a little bit more, like, hey, we have a park that's 40% occupied. Your performance says we're getting to 80% occupancy. Like, how are we getting there? Are we getting there with, high leverage chattel debt? Is that really sustainable? What's the global cash flow? I would say that's been, and I would say especially recently, that's been a sticking point, and I've, had to go back and forth a little bit to figure that out. So that's probably been a challenge a little bit on the very hairy deals. But then on, also another thing would be on a park owned you have your park. Let's say you're buying a park that's got heavy park owned home concentration, and the name of the game, obviously, and we'll get into that soon, I'm sure, as well, is park owned home to tenant owned home conversions. Like, is that really realistic? Is this a market that you could sell the homes in? Is this a market that you could get good RTO rent that's actually going to cover your costs to the park owned home? So I would say lenders have been digging in a lot more on the park owned home side, than they used to. I think, I've been part of a few quote unquote disaster stories where, you had a vacant park, someone brought in tons of homes, leveraged themselves to the hilt with park-owned home debt and sort of gotten in trouble. So I would say that's something to really, make sure we have ironed out up front to make the deal bankable.
So you hit a couple of things, and I do want to go further on that. So the interest, when we first looked at this space and we were looking at deals, banks would want to finance your park on lot rent only. They would totally discount the park owned home rent or the RTO income. They carried no value, right? This is going back a decade ago. So you would value a park strictly on what somebody would place that home on your land. And if they were paying you $300 a month, they would run their numbers on $300 a month, regardless of how much additional income you were generating. And the homes had, a shell value maybe, but the banks were not counting that at all. Now it's recently, and we've seen this a lot, I guess, a lot more prevalent over the last few years, especially with the values that people are looking at for some of these communities, is I've seen a lot more operators either taking those homes as either rentals, right? Or that are using that RTO income to look at that global cash flow. Are lenders, when you're saying lenders are re-looking at that additional income stream, are they counting that? Are you getting a discount for that? Because we've seen, right, when we run our lot rent, right, we have our operational expense ratio is low, right? Could be very low. But once you add in that overage, right, and you run on park owned homes, it's a different model. The repairs and maintenance are more, just a higher cost of operating that section. Like, how are banks looking at that? Are they getting are they easing the requirements to buy a park that has park owned homes and not discounting all of that lot rent, all that, additional rent?
Yes, great question. So I guess I'll answer that in two parts. So I would say the more institutional style lenders are pretty, still pretty quote unquote old school, the old school approach. They really only want to see the tenant owned home, lot rent income, lot rent expenses, strip out all the park owned home stuff. So to answer your question, even to work with those lenders, there are ways to really come out on top and sort of, get the best bang for your buck on a park like that. And I'll explain. Um, let's say you have a park, right? I'll try to make it a very simple example. Let's say you have a park, it's 100% park owned homes, and there's no allocation on, the seller's rent roll between the park owned home income and, and the lot rent income. There's no allocation in the lot rent, right? Let's say, it's $1,000 across the board, park's 100% park owned homes. I'll make it really easy, 100% occupied, right? So we could get creative, and I've gotten a lot of deals done this way where there's no allocation towards the lot rent. Okay, so let's take the highest possible market lot rent. Let's find the best possible comp. And we found comps for $750, let's say. And all of a sudden, even to approach a lender who is not going to count any of the park on home income, the deal works because you're allocating so much toward the lot rent. That's really, I would say, the best trick, if you want to call it, to getting a deal done with a lender who doesn't count park on home income. You try to allocate as much towards the lot rent and, call it a day. Obviously, the challenge with those type of lenders is a lot of times they don't like parks that have such high park on home concentrations. But I think, and that's really I would say the first answer. The biggest update that we've seen in a positive sense is that, Fannie Mae, Freddie Mac, CMBS, even more, some of the bigger banks, some of the more institutional style banks have definitely gotten a lot more lax with park on home concentrations. Whereas it used to be Fannie would never allow, a park to get done that was over 30% park on homes. Recently, we've done parks as high as 50, 55. I think the highest I've done is I think it was 59% park on homes with Fannie Mae specifically. CMBS, recently we did a deal with 80% park on home concentration. So that's definitely positive news for the whole industry, where they're allowing deals to get done with high park on home concentrations where they used to frown on those parks and not want to touch them. That's
So,
really
and for those of you listening, that's huge, because there was that 30% mark was a hard stop. I mean, if you had 33%, you had to get rid of that home from your books. You had to either give the home to the resident. You had to figure something out to make it a tenant owned home. And you're saying now the agencies are willing to consider, is this across the board in any market, or was there other things that were factors in them to go as high as 80%?
So that's a great question. I would say when it comes to Fannie Mae specifically, right, they have a lot of buy boxes that they're looking to check. I'll give you a few examples. That 50 pad minimum, they're looking for parks that are 3 stars or above, got decent curb appeal. So if you're in a pretty strong market and your park, let's say, checks all the boxes and you're not looking for any other, we call them waivers from Fannie Mae, for, other things, maybe it's on, well water or it's in a flood zone and you need a waiver from Fannie. Meaning, if you're going to approach Fannie with a park that is, a high park on home concentration, and it's got other things that you need favors from them from, the deal's probably not going to happen. But if you have a park, again, going back to the sponsor experience, if you have a park with a very strong sponsor, it's got a proven track record, it's a nice park and it checks all the boxes, but it's got high park on home concentration, we've had a lot of success getting that waiver from Fannie Mae. And I think that's great news for our industry in general because there's so many big institutional buyers and even some of the smaller guys who really weren't able to touch parks with high park on home concentrations. And now, there are just more choices in the lending world and it just makes things easier. I would say that's really, you know, part number one. Part number two, in terms of the underwriting, right? So that's, getting deals done with high park on home concentrations. But sort of zooming in a little bit on the underwriting, you know, a lot of the bigger guys are still very adamant, we don't want to count any of the park on home income, and also we'll discount the expenses attributed to the park on homes, but we just want to count for our debt service coverage ratio, we just want to count lot rent income and expenses. I would say in the banking world, a lot of the smaller regional banks, we've had some success, getting banks to start, even if they're not fully, counting the park on home income. If, let's say, it's a tight deal, you're buying a park, and this is super common. I'm sure you could, commiserate, quote unquote, Frank. Like, you're buying a park from a mom and pop, owner. He's, lot rents are $150, and I mean the market's 500. Let's say, I mean, pretty common, and obviously that makes it a really good deal. But it's just really hard on the front end to get even any leverage from a bank if you know lot rents are $150. It's just our debt service coverage ratio is not going to work. So in those instances, I've very often gotten a bank to, let's say we're at a 1-1 debt service coverage ratio, and the bank's got to be at a 1.25, let's say, which is pretty standard across the industry, and we have some park on home income. I've seen them be able to lean on that park on home income a little bit to get us to a normal leverage point that would work for, the buyer. So that's and you have your historic few lenders who do lend on park on homes and they count the income, but those lenders are a bit pricey. So, we do try to stay away from them. So to get a deal done sort of with a bank that, has a high park on home concentration, I would say it's definitely moving in the right direction to be able to lean a bit on that park on home income to get us to the threshold we need to get, decent leverage for a buyer.
So what I pulled out of that is, if you have a park, and this goes back to putting that story together and talking with you first. If you have a park that has a lot of park owned home or a heavy park owned home concentration, you may be able to get traditional financing if the park checks all the other boxes that are there, and there wasn't a lot of other things that favors you have to ask. But let's assume that you could look at it as, hey, let's find the high watermark in that market and say that that's going to be the lot rent, and we're going to just shift the income. We're going to dispose of the homes, and we're going to move to a lot rent only. We're going to discount some of that overage, but at least we're going to get the high watermark, which can create some value. And if it's in
Exactly.
some real or in some real extreme circumstances, if the lot rents are really low, there might be some lenders who say, well, I understand the lot rents are really low across the board because it's mom and pop, and you're getting, $600 a month rent. I realize I've got to lean on a little bit on that park owned home rent to make those numbers work, because there is some intrinsic value in the land. I mean, those are the big three takeaways I'm getting from what you
You
said.
nailed it. Yes, you
Okay.
nailed it. Exactly.
Yeah.
That's it, again, just zooming out a little bit on the macro, it really takes creativity. And I'm sure, I do want to get into that a little bit where, in the challenging environment we're in, I have people approaching me all the time with, a deal. Every deal's got something these days. And you
Yes.
just got to be creative. It takes creativity. You got to think outside the box. You got to present the deal in the right light. You got to try to, think of ways to get past those, problems. And, if you're willing to do it, it's possible to get deals done and really good deals done in this environment.
So and that's a great segue into the next question. When you talk about creativity, I mean, what are some of the creative ways you're seeing the best sponsors get deals done now? Like if you want to buy a value add deal, you have a sponsor that has a track record, or you have an operator that has a track record. Like, how are you seeing some of those creative ways that you're getting these deals done where there's enough capital to execute the business plan, and you're able to bring in some bank debt in a very challenging environment? To your point, it is tough getting a loan out now, even though it's gotten a little bit easier. Rates have started to come back a little bit. It is challenging getting a deal done. So, what are some of the creative ways you're seeing some of the best sponsors get execute?
Yeah, great question. I would say the easiest and best way, which is my biggest competitor, is seller financing. Obviously, that's always been there, but for a lot of deals, it's just not an option. But seller financing obviously is for a super hairy deal. If you could get the seller to play ball, obviously that's the easiest way. Where if you have a deal where obviously the seller he wants to cash out, he's done, he wants to call it a day, and we need to find a bank. The number one, again, just going back to our first point, I can't stress this enough. It's really sponsor experience. If I have a sponsor who's got the experience, I could show them deals that they've turned around and deals that they brought to the finish line and deals maybe they even exited and their success in the industry. I have banks, many banks, who they don't even really care. Obviously, they have to check, quote unquote, the underwriting box, and the deal's got to sort of make sense. But even if the numbers are not really there, if they could hang their hat on the sponsor, and they could say, "Wow, this," they really count the sponsor experience even more than the underwriting, which is something that really helps us get deals done that are may seem impossible on paper. That's really the easiest way for me to try to get a deal done like that. Other creative ways to get deals done that don't underwrite is obviously bridge debt, which is expensive, and in the MH space is not there are not that many bridge lenders in the MH space really, at all. Historically, it's been even less. It's gotten a little better, I would say, lately. There are some, but for the right sponsor with experience, if we have a deal that really doesn't make sense, or even some development we've been doing recently, but there are quote unquote bridge lenders out there who again could buy into your business plan. They purely underwrite to pro forma. They won't even look at the existing numbers. That's sort of another way to get a challenging deal done that maybe doesn't underwrite day one. Recently, a few times, it's very interesting. I've gotten a deal done. This specific deal was in Alabama, just closed a couple of weeks ago, where a lender, super low lot rents. I think the lot rents were like an average of like $225. And the bank's like, hey, I mean, I could give you like 45% leverage, but the numbers just don't add up. Um, I've done this twice in the last few months. We got the seller to you know, raise lot rents. And it's actually funny, on this last deal, the seller was like, hey, like maybe I don't want to sell this park. I didn't know I could, raise lot rents this much. But we got the seller to send out a rent increase notice prior to closing. The rent increase wasn't even in place yet, but the bank was able to hang their hat on that. I mean, again, you just got to think outside the box sometimes, and sometimes there's ways to,
Mordy, you're
get
giving
deals
away one
done.
of my secrets.
Oh yeah, is that yeah, that's another way I've gotten some deals done recently. I'm glad that you've done the same. That's awesome.
That's actually listen, when you're looking at bank debt, that's a great tool that somebody could utilize. It's the seller's leaving, and you don't want to be the bad guy walking in the door. But if they could do, especially when the lot rents are so low, if they can move that, guide that up a little bit closer to market, at least you can get a little bit of that velocity in that income happening, within the first 60 days, rather than waiting, 6, 9, 12 months to get something done. And then the second time around, it's not such a punch in the gut to the resident. It's the guy or the the person who's walking out the door, they're kind of like, hey, I've got to increase rents a little bit, and you can walk into additional cash flow. So that's a great tip for somebody out there listening, what they could do on a purchase.
Yep.
So and you kind of alluded to this before about where you've seen people get into trouble, right? You know, not coming in with chattel debt after they've already got financing on their park. I mean, what have you seen that's kind of separate those who've been able to execute on their business plan from those that, hey, you look back 24 months or 36 months later, and that person is now struggling and not able to execute? What have you noticed, or what have you seen that's kind of separated one from the other?
Yeah. So on the underwriting side, going back to performance numbers, I think it's super important. In the last few years, costs have just gone up in every industry, and obviously that's affected real estate as well. I've seen sponsors who didn't properly prepare for, real estate tax reassessments, and they didn't anticipate insurance being so expensive, and they didn't anticipate, them having to hire another maintenance tech. And really, I think that's why experience is so important. It just goes, again, going back to that. A guy who's been in the industry, he's been in the trenches, he knows how things work. Even if prices go up, and even if, maybe there are some surprises, he expects these things. He expects, real estate, there's always surprises in real estate. Nothing is going to go exactly according to your plan. That's just the way it works, right? So I think the guys who really have that experience, and even if things, were more expensive than anticipated, maybe, there was a problem that came up that they didn't wasn't in their business plan, and they didn't anticipate it, because they're nimble, and again, they're creative, and they're able to pivot, and they're able to, they know the industry well. I've seen those guys have success. Where I've seen people really struggle is, again, going back to that park own home debt. A lot of times people bring in homes too quickly. They bring in too many homes at a time, and sort of the homes just sit there. I've seen that time and time again, where a guy buys the deal, maybe it's 60% occupied, and all of a sudden, in one shot, he brings in 40 homes, and maybe it's a little bit of a smaller market, and he didn't realize that it's going to take time to fill these lots, and he's paying an astronomical amount towards his chattel debt. Again, the second they deliver that home, they're going to start wanting you to pay, your loan payments. I've seen people get in big trouble with that. You got to be very careful when you're bringing in homes, and a lot of times it's more expensive than they anticipate. And maybe, they're buying a home for 70K, and there's no market to sell a home for 70K in some of these smaller markets. People can't afford it. So I've seen people get in trouble with that. I've seen people get in trouble on really the total opposite flip side, on really the class A really nice parks, where in 2021, and even, believe it or not, today, they're selling at crazy cap rates. I mean, you still have parks, the real class, 5-star parks, with amenities, and people are buying them at really crazy cap rates. So, you have some of the bigger guys, the REITs, the insurance companies, that's really their business model, and they don't expect to make much. So, they do fine. But some of the smaller guys who paid such crazy prices for some of these parks, and, really their debts, they're not even covering debt service. Like, you have guys like just trying to stay above water. A lot of the lenders, they don't want to lose they don't want to lose their pants, the lender, because they know if they take this back, they're going to even lose money, even if they lent that 70% leverage. So they'll keep on extending your loan. You could talk to them and work with them, but I don't see really any path for these guys to, really come out on top, because, the park is literally not covering debt service. Like, it's pretty common. Those 2020, 2021, even 2022 prices were just, and obviously it's probably even more in multifamily. And the reason for that is, in the multifamily space, is because there was bridge debt out there, like crazy bridge debt options. You had bridge lenders lending left and right on deals that literally made absolutely no sense. And it was sort of a boon to our industry, going back to the bridge lender option. There aren't that many bridge lenders in the MH space. There are, but it was sort of a blessing in disguise for us that, hey, there weren't these crazy bridge options out there, because if we would have had those crazy bridge options, I think you would see a lot more, blood in the water. Where there are sponsors struggling, and they bought parks for, astronomically expensive prices, and I guess we'll see what happens. But I would say, you know, just to sum it up, there are really two the two main things are to watch out for the park owned home stuff. I think that's something that people get in trouble with. And then, we're sort of waiting and seeing what's going to happen with some of those parks that were purchased at those crazy prices a couple of years ago.
Yeah, there's two ways you can create value. You create value through your financing, which the guys like Blackstone, they could do that. They could buy at those compressed cap rates and then get some crazy financing down the road. But everybody else has to create value through the work. And I think the second part of it, and you hit on it, if your value add is you have to do infill, you really have to know the numbers in the market, because you could get, and you mentioned a huge thing, you could get, it's nice to say I brought in 30 homes, but if 20 of those homes are sitting because the absorption is going to be 10 homes a year, you're going to end up losing money regardless of what happens. And you could do very well if you could time that absorption rate correctly, but you've got to model it out right, and you got to be sure what that market can handle. So those are two other really, really excellent points, Mordy. Um, I want to just talk on this because I know that you just listen. I follow you on social media. I see you on LinkedIn. I see what you guys are doing. You just closed this 13 park, 2,500 pad portfolio. I'm sure it was just cake, right? You just took the entire underwriting package. You went to the lender and got it done. I mean, was it as simple as that?
Not at all. I can't go into too many details on the transaction, but I guess just to talk about it a little bit. It was a very complex deal. It was a real value add deal. I think the blended occupancy on that portfolio was 57%. Long story how I've been involved with these parks for quite a while. Put it that way. Been involved
Okay.
with the seller, and now the buyer. Did some debt for the seller on these parks a couple of years ago. But yeah, just all our points that we've went through in this podcast were super important for this deal. I mean, it was all sponsor experience and trying to find the right lender who could buy into the sponsor's business plan. It's an extremely complicated business plan. It's going to take really a lot of manpower and a lot of diligence to turn this whole portfolio around. But thankfully, we had a very strong relationship with a large national bank, and they were able to buy off on the sponsor's business plan. And yeah, I mean, it was tough. It was a very tough underwriting process. There was many points, I'm sure we all experience this on every deal, but many points where the deal almost died, came back to life. It was one of those really, I would say the entire transaction took over a year,
Wow.
just until the buyer and seller got to the price they wanted, multiple retrades on price, during due diligence. It was a very complicated deal, but those are the ones that feel the best when you close them. It's hard work, but it's worth it.
But it's important, in having the right team together to do that. And that's, you have the attorneys that are willing to work and work to get that done. But your lender has to be your partner on that, right? Because as much as your capital partner is important, your debt partner is important, and keeping them abreast every step of the way, because that will help get that deal to the finish line. And that's really a testament to you and your team really being able to keep track of what's going on. And I'm sure there was probably plenty of times during that transaction where you kind of had to, make the party see that, hey, here's the finish line. You guys might be on opposite sides of the table, but you're both trying to get to the same destination.
Absolutely. I always tell people there's got to be someone in the transaction. Sometimes it's an attorney, sometimes it's a debt broker. There's got to be someone who is really stepping outside of the lane, and I'll explain what I mean. And I try to make myself that guy in every transaction. If everyone stays in their lane, if the attorney's only doing their legal work, and the insurance guy's only doing his work, and the debt broker is only dealing with the debt, things just get complicated and things get delayed. I try to be the guy. Obviously, I do not have an expertise in title. I do not have an expertise. I'm not an attorney. But again, just trying to push things along and trying to be knowledgeable in every area of the transaction. I find that to be key. And I would say what separates me personally from the pack. I really try to get involved in every aspect of the deal, because there's so many different parties, especially on a large deal, even on a small deal. There's so many different parties. It takes an army to get a deal closed, and to really rally the troops and make sure everyone's on task and try to assist people on things that maybe have nothing to do with you. I'm the debt broker on the transaction. What do I care about insurance? Let them deal with it. But again, if you want to get a deal closed, you need insurance. So even though I'm a debt broker, many times I got to get involved in the insurance, maybe pivot, try to introduce them to a different insurance broker, try to, get creative. I mean, there's so many issues that come up on every deal. And unless you're nimble on your feet and you're willing to get uncomfortable and learn, get involved in things that have nothing to do with your job, deals just don't get closed. And you gotta be that guy. Just, you gotta just get out there and, make sure everyone's on task and assist everybody and, become an attorney, a title agent. You gotta do everything. And I think that's what I try to do on every transaction as much as I could. And, you know, uh, yeah, I think that's really specifically on this transaction. I think that's really what translated into success. I really got out of my comfort zone, got into every aspect of the deal, tried to really push things along, and thankfully we found the finish line.
You know what? I love that you say that because I say, to our team, you don't have a job, you have a role, right? And that, your role might be X, right? But here's the outcome we want. And we don't get paid on the job. We get paid on the role and the outcome, right? So we have to, and your role is that you're providing debt, but the outcome is where you get compensated. So you have to make sure you're doing all that. It doesn't matter if
100%.
if I've got to do something else to get it done, that's just part of the role to get to getting us to completion. So that's kudos to you, man. That's great. You know, we're having this podcast. It's last quarter of 2025. We're starting to see some changes in maybe some easing. I mean, we're coming out of a very listen. You've seen all the cycles. You went from COVID, where the rates were exceedingly low, and then all of a sudden, an extremely high interest rate environment. Where do you see the next 12 months, right? I'm not going to ask you 24 months, but like, where are you positioning the next 12 months, the lending space? And what do you see how that's impacting MH? Like, where do you see that fitting in if you had to go into your crystal ball for the next 12 months?
Right. I wish, obviously, just full transparency, I wish I had the crystal ball, and if I did, I would be living in Hawaii, and we wouldn't be talking probably. But I could only speculate, and it's real speculation. It's very hard to know, exactly where rates will be, obviously. Obviously, we had a lot, yesterday, they cut rates by 25 basis points. But, if you looked at the 5-year treasury, I mean, I got bombarded with text messages from everybody like, what do you mean, Morty? Mr. Powell cut rates by 25 basis points. Why is the 5-year and 10-year rising? I mean, they spiked like crazy. And the
Uh-huh.
answer to that is he sort of insinuated during his remarks after the rate cut during the press conference that a December rate cut is unlikely. And that's, multiple factors. I mean, we have the whole fire Powell trend. We don't want to get too political here, but but you know, it seems like they're not going to cut rates again in December, and that's due to inflation, other factors. Again, hard to know and put yourself in their mind exactly. Obviously, I'm rooting for another rate cut in December. What they're going to do in December is still obviously undecided. Um, it's because lenders sort of, I would say most of them, every lender bases their rate off of different factors. Some are prime based, some are treasury based, some are based off other indexes. Just specifically focusing on the treasuries because I would say most banks are, let's say off the 5-year treasury, and then you have Fannie and Freddie, which are obviously directly affected by the treasuries. And the treasuries are based on speculation, right? When the Feds cut rates by 25 basis points, that doesn't directly affect the treasury. That directly affects the prime rate. It directly affects SOFR usually, but it's not going to directly affect, the treasury rates because those are based on speculation, where rates are going to be in 5 years, where rates are going to be in 10 years. Um, me personally, just looking at the market, it does seem like the Fed, even if they don't cut in December, just based on job numbers, I mean, job numbers are not looking too good. A lot of the big companies are laying off staff. I mean, it's literally in headline news, it's out there. So, I mean, it seems like rates are going to come down. And obviously, once rates come down, you know, it's definitely going to help our entire industry. You have people waiting on the sidelines, like we discussed, trying to refinance debt that doesn't work, right? So I guess it's sort of me saying we shall see, but I do expect rates, I would say, to come down, going over the next, 12 months. But the question really is the velocity of it. Is the Fed going to be aggressive? Is the Fed going to cut rates, rapidly, or are they going to take many, many years to do so? So, it seems like they might be forced to do it a little more rapidly than than they would like. But what's going to happen? Again, I try to keep my finger on the pulse, and try to see, based on the macro environment, what to expect. And it does seem like rates should be coming down, but what's going to happen in the next 12 months really depends on, is the labor market really softening? Is that really going to get worse? Our unemployment numbers are going to start rising, and I think that would definitely force the Fed to cut rates pretty rapidly. But it's really, I would say we really got to wait and see what's going to happen.
That's been great. So Mordy, and here's my takeaways from this episode, and I've got, make sure you have a good business plan, make sure your track record's in place, get your lender team, get your debt team on board so they know exactly what's going, how you're going to execute, how you can fund, and have somebody like yourself who has the, access to the lenders that know, based on what your park has and the ingredients that are down on the ground, is going to work best. And I think you've given a lot of information on that, and that's been super helpful. And if anybody has questions, maybe about a deal they're working on or refinancing a deal that they're already in, how would they reach out to you? How would they find you? What's the best way to contact you guys?
I'm not shy. Text me 347-684-4910. We'll get it done for you. But I mean, thankfully, like as you're saying, the market is definitely picking back up. We're thankful. I'm thankful to be busy. Got a lot going on, but like I said, never be shy. Creativity is key. We pride ourselves in being creative. There's really no deal we can't get done. And again, Frank, I appreciate being on your show, man. I've watched it. I've seen a couple of episodes, and it's an honor to be here. It really is.
Well, Mordy, I really appreciate you being on. I thought I always love talking to you because you always got a great insight in the market in terms of what's going on and how things are going. And I'm going to ask you, listening right now, I'm going to ask you one question. Would you help someone you didn't know who was looking to learn about real estate investing or wanted to find out about finding, funding, or operating a mobile home park? And if your answer is yes, then give this episode a rating and share it and comment below on your streaming app. And if you share that review with the MHP Exchange, I'm going to send you a copy of the after site visit report that we do whenever we go down to one of our assets to keep our team moving forward to making sure the business plan is being executed. So that's our gift to you for helping this community and this program grow. So until next time, everyone, I'm Frank Rizzo. Stay disciplined, keep building real estate assets, and happy investing.